Communications is on our radar. It was a mixed quarter for the company as revenue saw a growth but margins contracted. Amur Lakshminarayanan, who's the MD and CEO of the company, joins us now to discuss more. Mr. Lakshminarayanan, thanks a lot for joining in. Can you just start by telling us what was the kind of organic growth that you saw in Tata Communications in this quarter?
The organic data growth was 10% year-on-year and 0.7% quarter-on-quarter.
Okay, 0.7% quarter-on-quarter. So there was a moderation. Perhaps the margins also further moderated by 60 basis points. Can you tell us what led to this drag?
Largely, no, I want us to look at the margins with a lens of our core business. And in the core business, the moderation has been less. And the core includes all of our data, digital portfolio, and the voice. And I had explained in the past as well, as we shift our portfolio more towards the digital portfolio for now has lower EBITDA. In fact, there's negative EBITDA in the digital business. And therefore, it has that effect. The mix effect has an effect as we grow the digital business. But all of these products in digital portfolio has a glide path that will come back to the profitability, which is when the overall profitability will go up. The second factor is, besides the mix effect, is the investments that we have done in people. Also, the M&A related expenses that have come into this quarter. That's another factor. The third is in Switch got consolidated, and Switch, we had mentioned before when we did the acquisition, has negative EBITDA, and we are looking to turn that around, and that is going to take next year it will get turned around from an EBITDA perspective, and that will start to contribute more positively. So these are the reasons why we see the decline in the EBITDA margins.
All right, hi, sir. Good morning. Could you tell us what are the core business margins?
The core, when I define the core, it's purely Datacom's data and voice. And if we, excluding the subsidiaries, right? So excluding, and subsidiary is another factor for the drag. So if I take all the subsidiaries out, it will be around 23% of in terms of EBITDA margins.
Okay. All right. Help us out with a few more details then. For how many more quarters will EBITDA margin stay below that guided band of 23 to 25%?
As I said, if I look at the core, so core, is a data business and voice business without the Switch. And the Switch has had an effect of margin dilution in this quarter. And it will take us a year to bring it back, or earlier if all things go well, to bring it back to at least EBITDA neutral, and then move it towards the direction of the EBITDA targets that we want in the media business. In the coming quarters, we also announced that we have had an accelerated closure of the Kaleyra deal, which we are very pleased with, because that gives us an opportunity to bring all the synergies of our Digo product and the Kaleyra together and exploit all the market synergies, because Kaleyra has significant market presence in the US and Europe and other markets, and gives us the handle on these markets much faster than what we anticipated, so we can start executing faster. But having said that, Kaleyra, it was a publicly listed company, so the data is available. Kaleyra is having a negative EBITDA, and that will also have an effect going forward. But when we did the Kaleyra announcement, we said the rationale was very sound, and also said that our efforts would be to make it EBITDA neutral within a year and make it more towards a double-digit EBITDA in a couple of years' time. So which is so if as all these things play out, is the reason why we said in the medium term for us to be in the 23-25% the range is a very valid ambition to have, and we will get there.
Got that, and that's quite detailed. But just trying to understand, what is medium term for you to get back on track with margins?
No, it's hard to, when we launched the Reimagine strategy in 2020, we were at 16% EBITDA margin, and we had put a medium-term goal to be at 21%, and we achieved it much ahead of time. So I don't want to pin this specifically down, but it will take a few quarters to get it back. And we are quite confident that we'll get it back to the 23-25% range.
Okay, so you will be able to sustain double-digit organic revenue growth as well, apart from getting margins back to 23 to 25%?
Macro is what it is. The indications only I will give are a few. Our funnel today is an all-time high. Having said that, in the last quarter, I said that the closures are getting delayed, and the same holds now as well. Some of the deals that we were hoping to close this quarter has got pushed out to the next quarter, and there is definite slowness in closing the deals. But having said that, because our funnel is rich, our first half order booking is better than last year's first half put together. We want it to be even higher, but it's not. But it's definitely better than the H1 of FY23. So we will continue to execute. The excitement on our part is that the entire story of digital fabric that we are taking to the customer, our digital fabric consisting of the entire connected infrastructure with our next-gen connectivity and all the overlay software-defined capabilities we bring, and the connected experience and connected solutions we bring, is resonating with the customer. And that is what we are most pleased with, because we are, increasing our relevance. Our levels of engagements are going up. The $1 million deals in the funnel are growing. So, we are moving in the right direction. Now, as far as the momentum is concerned, some of the macro will play out, but we are focused on the medium to long term, and some of the shorter term effects. Who knows? The conflict in the Middle East, how that's going to play out. It's very hard to double guess these things, but we will put our head down and continue in the path that we have set ourselves to.
Okay, all right, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts, and all the best for the quarters to come. That's Tata Communications, a beat on their revenues, and they say that the deal funnel continues to remain very strong. But we